Good evening, everybody. My name is Sean van den Berg. I'm from PSG Online. I head up client education. Welcome to our webinar this evening. We're going to discuss trading single stock futures and currency futures. I see a lot of regulars on this webinar again. Thanks, guys, for supporting us again. Just waiting for some other people to log in quickly. Anyway, here's the agenda for today or this evening. It's basically three parts. I'm going to talk about single stock futures, more about equity single stock futures, and obviously some of the terminology. And I'll highlight one or two long or short trades as examples. And then the second part, we're going to just briefly touch on trading index futures. And then some of you are interested in currency futures, and we'll have an example of a speculative trade there. Okay. Just while I'm still waiting for other people to log in quickly, I'll just start off quickly with a poll. Okay, how many of you have traded single stock futures before? If you guys can just participate in that while we're waiting for people to log in. Gives me an idea where I must pitch my presentation. Okay, most of you haven't so far. Okay, it's like 80% have never traded single stock futures before. Okay, great. Gives me a bit of idea. What is my audience? Okay, excellent. Okay, good. We're just waiting for everybody to answer the poll quickly while we're waiting for other people to log in. Excellent, great. Okay, so let's get started. Let's get into it. I think most people are in now by now. Let's talk about single stock futures and trading single stock futures. Obviously, this is more for the traders than investors. Single stock futures is obviously, you need more technical analysis and fundamentals, but I'll go into more detail with that. Okay, great. Thanks a lot for participating in the poll. 78% of you have never traded single stocks before. Excellent, excellent. Thanks a lot. Okay. So, what are single stock futures? First of all, gives you that peace of mind that they are regulated by the JSE. So, you've got some recourse if a counterparty doesn't come to the party as such, and they default. It's being regulated. Obviously, there's some recourse for you. So, being a regulated product is a standardized contract, and the contract consists of 100 shares. So, it's a parcel of 100 shares. You can't buy less than 100 shares. Okay. And also being a future, these things have a life. So 90 days or a quarter. The third Thursday of every quarter, we have expiry. For example, this Thursday, the 18th, we are doing the futures close out for the September quarter, and we're rolling over into the December quarter. Okay. But anyway, the third Thursday of every quarter, be it March, June, September, December, you have a contract that trades for that period of time, 90 days. Okay. Compared to an equity, the big difference here is that you don't have to put down 100% deposit to have the full exposure to the equity. You only need to put down what you call initial deposit or initial margin, which is roughly about 15%. We'll talk about it a bit later, but gives you that full 100% exposure. So it's nice and capital efficient. You can use your capital for other trades also. But saying that, everyone understands putting down initial margin. The difference comes in is you have that initial margin gets ring-fenced, and you need to keep it at 15% on a daily basis. So that's where we bring in what they call variation margin. So unrealized profits and losses are marked to or they call mark to market (MTM) on a daily basis to your single stock futures account. So it's not only the 15% margin you have to worry about. You have to have additional funds in case the market goes against you. If you don't have the funds available, you'll have what they call a margin call. Okay, you got until 3 o'clock the next afternoon to either deposit to bring it up back to 15%, or what happens is that at PSG we actually close out some of your positions to make up that margin. Okay, so just understand that this being a geared product, being a leveraged product, single stock futures are risky. It's not only the deposits you can lose more than that. Okay, so you guys are getting some feedback here. The guys are saying the sound is bad. I hope you can hear me a bit better now. Okay, Jan, is that better? Okay, looks like it's only the one person Okay. Only one person coming back to me. Okay. So that's just a quick introduction. Let's go into more call it terminology. We spoke about the word being a geared product. You should also understand that single stock futures belongs to a group of financial instruments called derivatives. And that word derivatives comes from the word derives. It derives its value on the underlying share. So those of you that are novice traders that are still trading equities, you still have to do that. You still have to do your homework on the underlying share, be it SAS or Anglos, Bulletins, wherever the case might be. When I say homework, it's fundamentals, technicals. More the technicals, more the timing is more crucial. Just understand that's where the word comes from. At PSG, we only trade the top 100 companies, the top 40 companies, which is called the large caps, and the next 60 companies, which is called the mid caps. So the reason why we do that is obviously because the risk. These are stocks that are more freely tradable, the better quality stocks, etc. Okay. Another thing compared to equities, with equities you can only buy the share and hope the share price is going to go up. If the share market starts coming off, as an equity trader, you either have to go into cash or you ride it out. Okay, so obviously as an equity shareholder, when the market's falling, you're going to be losing money. Nice thing about derivatives, especially of single stock futures now, is that you can go long, take advantage of rising prices like we do with equities, but also take advantage of falling prices. That's what we call going short. So going long, you're buying something at 5 Rand to sell at 10 Rand, okay, making 5 Rand there. But also going short, you're selling something at 10 Rand to buy back at 5 Rand. So you're still making 5 Rand there. The nice thing is you can make money in any market. That's what this enables you to do. So we spoke about initial margin just now. So I just want to highlight again, being a geared product, you're putting down 15% of margin, do you have 100% exposure? This magnifies your profits or losses up to 10 times. Okay, so just be aware of this. This comes with, I always say, a cigarette packet comes with a health warning. This comes with a wealth warning, in the sense that you not only lose your margin, you can lose much more than that. And I joke that you can lose the wife, the house, and the car. Not necessarily in that order. Okay, so it's very, very important to manage your risk when you're trading derivatives like single stock futures. Okay, so let's talk more about terminology. We talk about opening a position. You need to decide, I want to take advantage of rising prices, you open a long position. Or you decide to take advantage of falling prices, you open a short position. If you want to cash out or you take your profits or you want to cut your losses, whatever the case might be, you just do the opposite. So you sell if you're in a long position, and you buy if you're in a short position. Okay. When it comes to single stock futures, especially equity futures, understand that being a future, there's a expiry. You need to make a decision. Are you going to roll over into the next contract or are you going to close out and open up a new contract? I suggest that you always roll a position if you're happy with the direction of the market, because it is cheaper. We'll talk about cost just now. Okay, but you understand, if you're rolling a position, if I'm trading a SSF contract, September contract, I'll roll over into a SSF contract, but December. Okay, so it's still the same underlying instrument, just a next dated expiry contract. Okay, so it's very important. You need to make a decision. The default position at PSG Online will automatically roll you over. And obviously there's a cost involved there too, 0.25% of the exposure, which is still much cheaper than closing out and opening up a new contract. So just be aware of that situation. So let's talk about trading costs. So first of all, we've learned that they're capital efficient. You only need to put down 15%. Secondly, they are very cheap. Compared to equity trading, you only need to put down, or the cost is 0.4% excluding VAT. That's the value of the transaction. At PSG, we've got a sliding scale, 0.9% on equities. So this is half price. So you got the brokerage of 0.4. You also got a market maker's commission or fee of 0.1. So together 0.5 plus VAT. Okay, that's the brokerage fee. You can call it that. There's also what they call a booking fee. Now, a lot of people always forget about the booking fee. This is where single stock futures can be a bit more expensive compared to other forms of derivative trading. The booking fee is charged per single stock futures contract. For example, you only do it on the opening leg. If I want to go buy some SSF shares today, I only pay it once. Okay, in the sense that it's 60 Rand now and decide to buy another contract a bit later in the same day, and I still only pay it once. But if I open up a single stock futures contract on SASL today, and tomorrow I open up another contract, I'm going to pay that 60 Rand twice. As a percentage, that can push your costs up. And obviously, you have to go up much more to break even on cost. Be aware of that. So obviously, that's the brokerage side. If I'm putting down 15% deposit, I'm borrowing the other 85%. And obviously, the market makers, the Macquarie's, the Rand Merchant Banks, these are all market makers, the bankers are making the market. Okay, they are obviously making the market and borrowing the other 85%. So there's interest payable on the cost value of the transaction. It's roughly what they call SAFEX rates. It's call it prime less 2. Obviously a bit better when it comes on single stock futures because of the market makers. That deposit you're putting down, you also receive interest on that. Okay, so just understand that there are costs involved, and there's also obviously interest payable regarding this. But on the next slide, you'll see a practical example of a bulletin trade. Okay, let's say, for example, I want to go buy one bulletin contract, and the share was trading at 333 Rand 10. This was last week. I think it was on Wednesday when I did this slide. So your exposure, remember, one contract is 100 shares. So one contract times 33 Rand 10, if I put in Rand terms, my value of my transaction is 33,310. You'll see just now on the next slide that my margin required for me to have exposure to that is much, much less. And that's what attracts people to the market. But let's talk about costs. So my brokerage on that is 133 Rand 24. VAT on my brokerage is 14%, which is 18.65. Market makers commission, 33 Rand. So together, ultimately, my total cost, 249 Rand. That is percentage of my exposure, 0.75%. That's on the opening leg of the transaction. You can see why it's so cheap and why it's so attractive to a lot of private investors. Okay, so that's just the value of the transaction. Here's an example, a long example of bulletin. So yes, technicals is important. So this is why, well, this trade came up. If I bring in my cursor here quickly. Okay, so there we're bouncing off a support trend line. Number one. Number two, we're oversold on the stochastic and the RSI indicator. We're trading just below the 200-day moving average. I like to trade above it, but it's still about a change just below it. It's also bouncing off what I call a 38.2% retracement level, Fibonacci retracement. You can see there's a very important support level here. So the probability is that the price can bounce off here was very high, being oversold. Okay, so there's this is you always do on paper. There's my entry price. I need to know three things before I can put on the trade. My entry price, my target price. What's my target price? The previous high. Okay, you can also extrapolate this channel out. Okay, you can say 385. But I was happy just to go as high as 378. Okay, my stop price is 315, which is way back here, which is the previous low. Okay, you can say just a little below that. I like to be a bit more conservative. What's important is you want to work out the risk-reward ratio before putting on the trade. So my risk, the difference between my entry price and my stop price is 18 Rand 10. My reward from my entry price to my target price is 44 Rand. So divide that into that gives me my risk-reward ratio. So I'm willing to risk 1 Rand to make 2 Rand 48. Okay, you should never be below 1 to 2. Okay, you should never be in a situation where you're risking 1 Rand for 1 Rand. Ideally 1 to 3, 1 to 4, but never less than 1 to 2. Okay, so here's my margin requirement. I need to, on this particular contracts on bulletins. This is a JC requirement in Rand terms, 6,570 Rand to have 33,000 Rand exposure. Okay, so my potential profit was 44 Rand. Okay, 4,490 Rand. That's that times my one contract. So that divided by my initial margin, because that's money I'm putting down, I have the potential of making 68%. Okay, so that's where it gets where it gets more attractive. So I hope that makes a bit more sense to you guys. Why you're put on a trade like that. By the way, remember this presentation is being recorded, and those of you at PSG, you will be getting the presentation as well as the recording, and I know that Ralph from the JSC also be setting it out. Okay, any questions you guys have, just type it in the box and I'll try and answer all the questions near the end. Okay, let's move on. Here's a short trade. This is on Sunland last week. I was anticipating a breakout below that support trend line. Again, same scenario. I got my free 3 price levels I need to know before I put on the trade. I calculate my risk-reward ratio. So yes, just over 1.2. So just put my cursor back in again. Okay, 1.2. And in my risk-reward, my potential profit was 57%. So yes, ideally, I like to go short when it's below 200-day moving average. So this is what I call an aggressive trade. Someone going for high risk, high returns and high risk. Okay. So I prefer rather go short when it's above it, but around this point in time, there wasn't much opportunity. I just wanted to show you what kind of trade a short trade would look like. You can see both the stochastic and the RSI are trading on what they call overbought territories. This is highlighting or suggesting we're going to have a correction soon. And this you can see also it might be a bit of what they call a rising wedge. All those kind of patterns will start bending the odds in your favor and say, okay, this could be a potential pullback. Okay. This is what our PSG Online platform looks like, a single stock futures platform. This is the holdings account. So there you'll have all the different contracts in this situation are all long. You see they're all September contracts. We trade what they call dividend neutral contracts. So you can see there's a Q contract and then there's a F contract. So this is, we're anticipating between now and obviously September closeout, there will be dividends paid out, 3 cents. Okay, this is 10 contracts, 3 Rand. Okay, so in cents. So we've got a potential of receiving 3,000 Rand, but that's subtracted from that there. So you're not actually getting the dividend. So it's all priced in already. So what's taken off there, it's added back in the dividend side. But that gives you an example what a single stock futures will look like. Okay, the account. Very similar to equity account, very similar to a CFD. So it gives you your break even. And this is the worst case scenario. This might be 15 minutes delayed, so it'll get automatically updated for you. Okay, so that concludes the section on equity single stock futures. Here's a quote from John Novak. If you don't follow a written trading plan, you court disaster every time you enter the market. So what you saw just now with the entry price, the stop price and the target price, that's part of your game plan on a daily basis. Before you go into any trade, obviously game plan is part of the broader trading plan. So it's very important you have a detailed trading plan. Okay, very important to talk about risk management. We also talk about getting your timing right, which is the methodology. And also we talk about your mindset. But a part of your mindset is discipline and patience, and this all fits in with a trading plan. Okay, so let's talk about index futures. Okay, so we're talking about the ALSI. ALSI is giving you exposure to the top 40 shares in the markets, the index, that large cap you saw just now. We're talking about just now. This is the index of those shares. They're very popular, very liquid. Obviously, lots of institutions are involved there. They're also very, very cheap. So it only costs you 25 Rand per contract. There's no booking fee. That 60 Rand it doesn't apply here with the index future. Very tight spreads between the buyers and the sellers, the bids and offers. There might be like 20 pips, okay? Two points away from each other. But they're very, very narrow. You trade always at the index price. So whatever the index is trading at, be it 40,000 points, that's what you're trading at. But when it comes to index to Aussie futures, okay, it's not for everybody. We're talking about it now. Why? Each point is equal to 10 Rand. So these guys, especially for the day traders, guys love the traders. They like to go for a 100-point move, and obviously that's 1,000 Rand per contract. You do it 3 or 4 times a day, and maybe you have 5 or 6 contracts. That's got a nice little side business. Okay. You might want to go for 105 points because obviously 25 points or 25 Rand in and 25 Rand out. That'll cover your costs. Now, say it's not for everybody. Look at the margin requirement. 45,672 Rand to give you exposure over close to 500,000 Rand. Okay. So this is for the serious day traders. You want to be in and out the market 3 or 4 times a day. So someone that has the time to be sitting in front of the computer also. Okay, the smaller version of this is what we call the All Me, which gives you 10% of the All Z. So that you need 4,567 Rand. That's 1 Rand point movement, 5 Rand per contract. So it's a nice stepping stone. Okay, with the index future, there's no rollover. They automatically are closed out. Okay, so you have to open up a new December contract when it comes to close out. Okay, so just want to show you on the next slide. This has happened a few days ago. on the 10th of September. This is an intraday chart. This is what they call a 3-minute chart. You can see the previous day how the market closed. Below is moving averages, a whole range of moving averages. But the market opened with a gap down. And that gap was 144 points. So that was, if you were short, if you had gone short the previous day, okay, in anticipation, you could have seen what's happened with the Dow when the Dow opened and things like that. The Dow opened lower. You thought, okay, the moving averages are down. We're trading in the zone. Anticipate the market to open down tomorrow. Okay, let's say you did that. It's quite a risky trade, but anyway, let's say you did it. The market opened down 144 points, and then slowly drifted down another 180 points. In that short period of time, okay, from when the market opened, okay, remember futures market opens at 8:30, okay, till 10 o'clock, you could have the opportunity of made 324 points, or roughly 3,240 Rand. But let's say you missed that. You could have got it over here and still gone short, and then from there closed out your position, gone long. Okay, there you would have made 186 Rand. 186 points times 10, 1,860 Rand. Okay, that's what a day trader would do. 2 or 3 trades, and that's, I can tell you now, in 2 hours. That's how the guys would trade. Okay, let's move forward. This is what a contract looks like. What a ALSI contract looks like. If you guys could just see, yeah, this is a big account. This is got 25 contracts. I can highlight for you. You can see the exposure, 11 million Rand. Okay, so this is a serious trader. Yes, might down be around 57,000 Rand, but imagine making 100,000 Rand a day, or even more than that. Okay, so these are the serious traders that trade with PSG. Okay, let's move forward. Okay, so just a quick summarize before we move on to currency futures. The benefits of trading single stock futures, huge potential to make big profits. Okay, saying that, also big opportunities to make losses if you don't know what you're doing. Okay, accessibility, we only trade the top 100 companies, so they are very, very liquid. Okay, it gives you opportunity to go long and short. It's great also for the long-term investors. Those of you that have a long buy and hold portfolio, you might think the market is quite toppish now. You might anticipate a correction, and also have interest rates going up now. The market might start drifting lower. You want to hedge your existing investment portfolio. So, you know, if you're long of Sasol or you're long of any of the other industrial companies, you want to go short to those stocks. So what you lose on the swings on the equity side, you make up on the roundabouts on the single stock futures. That's what they call a hedge. And I mentioned before, remember, they're capital efficient. You don't need a lot of money. Compared to 20 years ago, it's much easier now to make money trading. Okay, and I mentioned also before, it's low trading costs, 0.4% compared to equities. Okay, so I hope you guys a bit more optimistic about those of you who have never traded single stock futures before, learned a bit more. So those of you who have never, can we launch another poll here quickly? Who of you have never traded currency futures before? You can just participate quickly in this poll. Okay, most of you haven't. Okay, same kind of margin again. It seems a bigger group of people have not traded single stock currency futures. Okay, great. I appreciate you guys participating in this poll. So this gives me a bit of idea of my audience. Excellent. Okay, 90% of you have never traded currency futures before. Excellent, guys. Thanks a lot. Thanks for participating. Okay, so let's talk about currency futures. First of all, again, they are regulated by the JSE, so it gives you that peace of mind. Okay, there's a big difference between currency futures and spot forex. Remember, currency futures is regulated by the JSE. Spot futures is not regulated. Okay, so they've been around for about 7 years now. Again, it's a standardized contract, and a contract is 1,000 of the underlying foreign currency, be it $1,000, 1,000 euros, 1,000 pounds. Okay, it's always relative to the rand. Okay, so your value of your exposure is $1,000, and then multiply that by the exchange rate. So this was a few days ago when the rand was still below 11 rand to the dollar. So one contract in this situation, the value of exposure would have been 10,988 Rand against the dollar, against the euro, 14,213, and against the pound, 7,856. Those are the three most popular currency pairs that people trade. But the main idea is that you as a currency future trader have exposure to the movements of these currencies relative to the rand. Okay, so you can still go long and short, anticipating the rand to get stronger or weaker. I prefer to use those terms. So always remember, it's from the other currency to the rand. So you're either going to buy the dollar or you're going to sell the dollar relative to the rand. You're anticipating the rand's going to get weaker. You saw last week 10 rand 98, and you anticipate it's going to go over 11 rand. You'd buy the dollar and sell the rand. In other words, you're anticipating rand weakness. If you anticipate that the rand has run up a lot now, and ahead of the MPC meeting on Thursday, that's going to get stronger because they're going to raise interest rates. I'm speculating that the rand will get stronger. You'd sell the dollar. In other words, you'd be buying the rand because anticipating rand strength. Okay. So remember, it's against the rand. So no money's going out of the country. So you don't have to get any tax clearance. You're not taking advantage of your tax offshore allowance or anything like that. So this is ideal for a speculator or someone who wants a hedge, especially if you've got some rand hedge elements in your share portfolio. This is a nice way to hedge yourself regarding that rand hedge. Okay. So let's go into more of the nitty-gritties. Being a future game, remember, it's got a closeout the third Monday of every quarter. Okay, we have a futures closeout. We just had one now last week. Okay, roll-up costs are also very cheap. Okay, so it's only 18 rand per contract on the opening leg, and obviously 18 rand to close. So in and out the market, 36 rand. Your trade must go up 4% to break even. 3.6% or 3.6 pips as such, or 4 cents to break even. So remember, again, it's a geared product. You don't have to put down a full amount. You don't have to put out $10,000 down or 10,000 rand. Put down roughly about 10 to 20%. So at PSG, we work on 2 times the JSE margin. So at this point in time, the US dollar rand margin requirement is 470 rand. That's times 2. You'll see in the next slide where I show that. You need to put down 940 rand to have exposure of over 10,000 rand. So that's where the gearing comes in. At leverage, you get up 10 times. So 1 cent movement equals to 10 rand. Similar like the ALSI, 1 cent is equal to 10 rand in movement. We go so far as 4 decimal points. That's 10.9488. Okay, so each point will be equal to 10 rand. Remember, when I close out my contract, all contracts, all kinds of futures contracts are always settled in rands. Okay. So here's a practical example of a speculative trade. Okay. My initial margin, I want to go buy 100 contracts. So I remember my contract was 940 rand. So this shows you it's a negative number. The money's going out of my account. So 100 contracts was 94,000 rand. I've got 100 contracts times 18 rand. That's my brokerage. Okay. On this day, I'm anticipating the rand's going to get stronger. So I'm very optimistic. I'm buying. I'm selling the dollar. In other words, buying the rand. So if I had to do a quick shortcut, yeah, you can see what I'm trying to get at. Bring my cursor back in. I don't know why it's not working now. Whoops. Somehow I've lost my cursor. Sorry, guys. Okay. So there's 10.95. Anticipate the market's going to get stronger. Anyway, after 4 days, it's 10.65. So I'm making 30 cents. 30 cents on 100 contracts. So this is what this whole exercise is going to show you. So I just want to show you the cash flow table. So I trade at 10.95. That's the traded price. If you guys can, I don't know if you can see that. Yeah, 10.95. But market to market, when the market closed at 5 o'clock, okay, it was 10.95. 10.85. So the difference between the two of them, what's 10 cents? I've got 100 contracts. I made 100 rand times 1,000, so I've got 10,000. Less my 1,800 rand on the first day of brokerage. So my net cash flow for the day on the very first day is 8,200 rand. Not too shabby, eh? Next day the market opens. Now when the traded price is the previous day is marked to market. So it's 10.85. That's where it comes from. Okay, 10.85 from market to market. The market it closes down again. So the difference between the two of them is 10 cents. I'm just trying to keep it as simple as possible. Again, another 100 Rand, another 10,000 Rand on that day. Okay. Next day, the market opens. Remember, my previous day's market to market is my opening price. Okay, I'm using these simple terms. We can call it opening price. And this day, the market actually went against us. The Rand got weaker. So it went from 10.75 to 10.85. The difference here, again, 10 cents. So yeah, 10,000 Rand gets taken out of my account on that day. Okay. On the fourth day, I decide, okay, I'm happy with my profits. The share price has dropped to remember, again, the previous mark to market is 10.85. That's been my opening price. The market drops to 10.65. So it went from 10.85 from 10.95 to 10.65. Directly, I made 30 cents times my 100 contracts. And in this situation, I made my 20,000 Rand. Okay, the market dropped 20%, 20 points, 20 cents. Times my 100 contracts times 1,000 underlying. There's my brokerage, because remember I'm closing out now. So I'm paying 18 Rand per contract times 100 contracts. So there's my 18,000 Rand. Add that up, plus that, minus my 10,000 Rand. So I make my 30,000 less my 3,600 Rand in brokerage, 2,400 Rand. Okay. That's how a simple trade would look like. So it's easy to put in an Excel spreadsheet like this. So it explains to you how it works. Okay. So this is where he has an example of a currency futures trade. This is only one contract. Okay, so he's long of the US dollar. Okay, there's a margin requirement. So he's putting 940 Rand down. Okay, so it's only one contract. So obviously it's very new store, but he's in positive territory. You see, so we've got some cash available. It's always advisable to have some cash for those drawdowns and things like that. Okay. So what are the benefits of trading currency futures? You know the currency rate that you're trading, and it's locked in. So you don't have to worry about the prices changing. It's locked in. Okay. There's no hold to. You can close out this contract whenever you want to. So you don't have to hold it to expiry. You buy it now. 10 minutes later, the market's moved moved with you, and you're 10 cents in the money. Get out, like you saw just now with the index futures. Currency futures are great for day trading. Okay, it's a very liquid market. Remember, it's a geared product. It's also great. Remember, we spoke about the speculators and the hedgers. Also very important for the importers and the exporters, that you can use it as a hedge. You can use it more effectively or more efficiently. Okay, it's very easy to get in and out of positions. Okay, remember the costs are very, very low, 18 Rand per contract, and remember it's always settled in rands. Okay. Here's a quote from Dr. Alexander Elder. Those of you that might have read his book, Coming to My Trading Room. Goal of a successful trader is to make the best trades. Money is secondary. So that's why that paper, doing the paper trades and things like that is important. Before putting on the trade, you need to know where you're getting in and out. That's why I like using Excel spreadsheets. Okay. So guys, I hope you've enjoyed that. Just quickly summarize. Remember, single stock futures are regulated by the JSE. You can go long and short. It's ideal for the hedger or the speculator, and obviously being a geared product is attractive for the small trader, because obviously you need a minimum outlay, and obviously the cost is also much lower. Okay. Equity single stock futures are great for what I call a swing trader, someone holding a position from 2 days to 30 days. Most of you will be what they call swing traders. Some of you might be more of the day traders. People have more time. Can be watching the market the whole time. So index futures and currency futures are great for the serious day traders. Okay. So as I said, this presentation is being sent out to you guys. Those of you who haven't got a single stock futures account or a currency futures account with us, open up, and then you don't have to start trading straight away. Paper trade. Have an Excel spreadsheet. What if scenarios? Doesn't cost you anything. Okay. So look out for our upcoming webinars. Just quickly highlight for you guys. This Wednesday, lunchtime, I'm discussing trading strategies. So it fits in nicely what we spoke about tonight. I'm talking about trading gaps. And then going forward in October, I'm talking about Japanese candlesticks, some bullish and bearish patterns. And then also talking more about technical indicators in the end of October. And in November, I'm talking about investment clubs. Those of you that are from Centurion, I'm in Pretoria tomorrow night for our Traders Forum. There's still lots of place available. Please go online and just book a seat with us. It's at Centurion Country Club from 6 o'clock to 8 o'clock, and we have cocktails afterwards. Those of you in Cape Town, I'm there at the end of the month, and we're back here in Joburg in October. Okay, in November, I'm off to Vegas for a big conference. Okay. Anyway, there's my contact details. Let's see what questions are coming up here. Okay. Okay, before we tackle any questions, let me just check my last little poll. Those of you that answered no just now, how many of you now would trade single stock futures or currency futures? Or do you still need some more help? Okay. Much better. Excellent, much better ratios. Okay. Awesome. Okay, while you guys are still answering the polls, let me see what questions have come through here. I don't know if I pronounced your name properly. Pomutso, what's the difference between the single stock futures and the CFD? The big difference, obviously, is that the CFDs are not regulated. I know the JSE has launched their own, call it ECFDs. It's more the institutions. But that's a big difference between the two of them. CFD is more OTC, so you're dealing with a stockbroking firm. PSG have been trading CFDs longer than single stock futures. We offer both. The big difference, I believe, is that you actually get a synthetic dividend. Maybe with single stock futures, you don't actually get the dividend. The costs are slightly lower in the sense that there's no booking fee, but then the interest rates might be a bit higher. So there's pros and cons. And the big difference I like about CFDs is that there's no expiry, so there's no rollover costs. So it's more ideal for the position trader. Someone wants to buy and hold, be more of an active investor. So there's a big difference. I hope that answers your question, Pomoto. Thank you. Okay. Okay, yes, I did calculate, Jacques, explain the risk margin and reward. Basically, it's just the difference between your entry price and your exit price, and your entry price relative to your stop loss. So calculate your risk reward ratio rather. Okay, I'm not 100% sure you're talking about your reward margin. Okay. No. Okay, here's a question from, I don't know who put that question in. Yeah, single stock futures, you don't have to get out at expiry. You can get out whenever you want to. Okay, so just understand that the contract expires the third Thursday of every month. So if you're in the contract, understand that it's going to be automatically roll over to the next contract. But you can get out whenever you want to. So I don't know who asked that question. They didn't put their name in none. Okay. Okay, sorry, it was a question from Vanna. Try and keep the questions short and sweet. Okay, Gus, I've answered that same question just now. What's the difference between single stock futures and CFDs? I've answered that already. What are the advantages of single stock? Okay, one of the biggest advantages of single stocks over CFDs, and it's cheaper to go short using single stock futures. Where CFDs, you want to go short, there's a additional cost. What do you call a scrip lending fee? 1.5% per annum of the value of the transaction, or minimum of 250 Rand. So that's one of the major advantages of single stock futures over CFDs, that it's cheaper to go short. Okay, Ross, I hope that answers your question. Okay. Okay. Guys, you know, there's the presentation. Let's see the poll. Okay, yes, we're seeing the poll. Yeah. So there's my contact details. Hope you guys can see that. Appreciate you guys taking advantage of the polls. But everything I spoke about tonight was for education purposes only. So here's my my disclaimer. So don't rush out and go buy bulletins and things like that. because remember that was last week's graphs, but remember it's for education purposes only. But from my side, thanks for participating. I hope you guys enjoyed it, and we'll talk again. All the best. Thanks a lot. Bye-bye.